Welcome, and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. I'm your host, Matt Kors, Managing Director with the Crexi Auction Team, and today we're thrilled to sit down with Alix Kogan of Ashland Capital. Before we dive in, a little bit about our guest. Alix has been involved in real estate, construction, and development for the last 20 years. He started his career in Colorado, founding his high-end construction company and growing it to be one of the most premier firms in Southwest Colorado. After 20 years there, Alix had a successful sale and liquidity event in 2019 and returned to his hometown of Chicago in 2017. Shortly after starting his own building company in 1999, Alix started investing in real estate with single-family rentals, commercial, and multifamily rentals, as well as student housing. Over his career, Alix has completed several townhome, mixed-use, and single-family developments totaling nearly $1 billion in real estate and development transaction value. He currently owns over 2,800 apartment units, nearly 1,300 student housing beds. Alix has a broad-based experience and knowledge of multiple real estate asset classes and is focused full-time on growing his private equity real estate firm. Alix, welcome to the podcast today, and thanks for joining us.
Hey, Matt. Glad to be here.
Hey, absolutely. I know it's you're in Chicago and I'm in Chicago. It's a pretty warm day today. We're recording on September 20th, but I think that might be coming to an end shortly here.
Enjoy it while it lasts.
Absolutely, man. Absolutely. Well, look, I know you're a busy guy, so let's dig in here. You obviously have a very robust career, and I want to get into the Ashland Capital side, but maybe start by taking us back to the Colorado days, or before, whatever kind of makes sense on your end, and how you got into this industry, and maybe, choosing the construction side first and foremost before development and so on and so forth.
Sure. The story starts really when I was in my early 20s and trying to figure out what I wanted to do in life and who I want to be and all that. And I grew up in the construction development family. Both my father was a developer builder. My brother is a developer builder here in Chicago. So I knew one thing, that it was an interesting business, but it was something that I did not want to do. I did not want to follow the family business. And it was, I think, really more of, I wanted my own identity. I didn't want to just be labeled as following in the family footsteps. So
that makes sense. I hear you.
Yeah. You want to be that unique sort of family member, and that I was, in the fact that I decided to save the world and teach high school, and prior to that, travel the world, did a lot of crazy things, or unconventional, I would say, and decided in, I think it was the 96-ish, to move to Northern Arizona and teach on a Navajo reservation, teach high school. And
that's the most furthest you can get from construction and commercial real estate, if I had to guess. Teaching high school.
Very much so. So did that, taught for a year and a half, realized that it was, something that was interesting and I enjoyed it, but certainly it was not my passion. And after a year and a half, I realized that I think I was just more or less running away from, the family business. I was kind of the black sheep, wanted to forge my own path. But in reality, when you grow up around the business, it is part of your DNA. You appreciate, you love real estate. And so I decided to move to Southwest Colorado after a year and a half, and went to work for another builder, did that for about a year and a half, and then launched my own company. And really did what my family did to a certain degree. My firm was a little bit different, but that was really the background and how I got into construction.
Wow. Okay. So that's a pretty cool story there, man. I could go on for probably an hour on just, before the construction side of things, but let's stay focused here. So as an entrepreneur, I guess from that side of things, was Colorado kind of an accident for you, like just because you were in that area? Because I know that it's just been, on fire from a building standpoint. Everything's growing there. But yeah, was that kind of how you ended up over there?
Total. Well, I mean, it was an accident, but it was not it certainly wasn't a strategic business decision. It was,
okay.
I had been visiting Durango, Colorado, and all of Southwest Colorado for a number of years. But basically playing in Colorado. And when I decided to move, there was some thought, obviously. I looked around the market. I realized the market was starting to boom. I realized that the sophistication level of the firms that were out there were kind of marginal. So I knew there was an opportunity. But the first thing was lifestyle. I said this would be a great town to live, and that's what really drove the decision.
Nice. Okay. And when you got there, then knowing what you did from your family business, did you get right into like a similar product type and things like that from the construction side of things, or maybe what did it look like early on from that side?
It was different. So I'd like to say that I've got kind of a left brain, right brain, and so I've got a creative side. And I was fortunate enough to work for a design builder for about a year running his company when I first started in Colorado. And the one thing that stood out was that was a differentiator. They were design build, which was a new concept. In the mid to late 90s, I think design build was just really starting. And I love the idea of designing and building and having a vertically integrated shop. Fast forward, we'll talk about how, we added on acquisitions and property management and just really built out an umbrella platform. But that was the one thing that I did that was different than my family. I think both, my brother and dad will tell you they weren't the creative type. They were, sort of bootstrapping, scrappy entrepreneurs that loved construction and development. But I certainly went down that path, and we built a really cool vertical where we had architects and interior designers, of course, the whole construction crew, all under one roof. And that was definitely a different concept than my family had been doing. Additionally, the homes in Colorado that we designed and built were so unique and so different. There's, no two homes are the same. Whereas in Chicago, I think you can understand and appreciate that the suburbs, there's similarities, right? I mean, every lot is flat, every lot is small. There's no views to speak of. So, it's a really different experience, a different type of company.
That's really cool. I mean, would you say then, was your family your mentors kind of from afar, would you say, from getting it going, or anyone else maybe that helped you kind of get things moving?
Yeah, that's a good question. I would say the biggest thing that my family did for me, which is something I think about today because I have a 7-year-old, is really instill a sense of confidence. Maybe too much in certain cases. You're always your mother's. You could do no wrong. You're perfect in your mother's eyes. But that was really, I think, both my parents gave me is a sense of confidence, a sense of entrepreneurialism, and that they sort of had that attitude. Like my dad would never take no for an answer. If he wanted to do something, he had the grit and fortitude to get it done. So really, that I think was the most important part for me. I just said, I'm going to start a construction company tomorrow. Most people would have been a lot more measured and maybe, a little bit fearful, but I just jumped in and did it, and that served me well. So I think that was really sort of a mentor, if you will. But I really didn't have one mentor along the way. I had lots of people that I came across that I emulated and respected and just followed what they did. And over now it's been almost 24 years. It's just a process of trial and error. Don't make that same mistake twice.
Yeah, that's a really cool story, man. In thinking about like lessons maybe you learned early on, because you did that for 20 some years, is that correct, in Colorado?
Yeah. The Colorado firm was about 20 years ish. And then, there was an overlap where I started this firm, which we can get to, sort of the transition out of Colorado back to Chicago. But there was an overlap where I started my new firm while owning, but not really operating the original company I founded. But since 2017, we pivoted, as you know, and started, buying apartments and student housing of a larger scale. And that was a transition of the business.
So when you, in looking at it from the Colorado standpoint, when you started in Durango and Telluride, did it just start growing from there, just taking on more locations and different product types, or was your vision with the vertically integrated firm under one roof that just wasn't out there yet, so that was just kind of taken off?
Yeah, the vertically integrated design build, there was another firm that did it sort of on an okay level. So that was the initial sort of the business plan. The company, took off like a rocket ship. We doubled in size every year for many years, and became, really the market leader. And then along the way, really what happened, sort of by accident, but sort of by, I guess, the need to reinvest my capital. So I always lived under my means, and the business was doing great. I was single, no kids, very low overhead and expense. It's just my style. I don't need a
Must have been
lot.
a fun time.
That's for another podcast. It was a good time. So, I had all this disposable cash, and my family, they also, were investors and bought assets, developed assets. I started buying everything I could get my hands on that made sense,
Okay.
that would cash flow. So here I am with this vertical of the primary company was building high-end homes. Shortly thereafter, another vertical was development. So we started buying land, building subdivisions, doing some townhomes, some condos, some mixed use, a little bit of commercial. So all of that just started
Okay.
sort of growing underneath the parent company. And then on the side, going back to the disposable income, all the money that those two verticals had generated, I would plow back into buying more real estate. That if I could just buy, a duplex, a triplex, whatever it was that made sense, I would buy. And I did that over 20 years. And it was a great run. We self-managed my personal portfolio. We ran the other company and just grew them over 20 years.
Wow. That's really cool, man. And I am assuming then this is now at this time or at some point you started getting outside of Colorado or outside of the Southwest area with the portfolio side of things. Maybe not was the high end residential primarily just in Southern Colorado?
So there was an interesting overlap. So fast forward to about, I think it's 2011, my brother, who had at the same time been building and developing high end luxury homes, between 1 and call it 6-7 million in Chicago at the same time, saw what I had done in Colorado, which is, really made it a sustainable company with processes and systems and a good team. And while he was very successful, he didn't have the backbone and structure. So he asked me to partner with him to help him scale and grow his business. So for 5 years straight, I would travel back to Chicago 1 week a month. And then while I was in Colorado, work remotely. So I'm running my company, but I'm also helping him at the same time grow his company. So we partnered and did that for 5 years straight. We also bought some real estate here in Chicago, developed some real estate, grew his custom home building company. And then we had an opportunity to buy a large apartment community in Wisconsin, in Racine, Wisconsin. Anyways,
Okay.
long story short, I won't bore you with all the details, but got to the closing table in essence days before, and there was a third partner involved that I just, I go by my gut. I just did not have a good gut feel for the third partner, and I just felt like there's going to be conflict. We didn't transact. I pulled the plug in the 12th hour, and then the other partners also, realized the opportunity wasn't what we thought it was. But it's that opportunity that got me really started down the path of wanting to sell all of my smaller assets and transition into buying more institutional size, larger assets. I think this deal was like a 250 unit deal.
Okay.
And so I took some time to really go back to that. I started investing as an LP in syndicated deals, kind of watching markets, watching the structure. And then about 2017, I said, I'm ready. I want I want to start doing this myself and syndicating deals and buying larger opportunities. And that was that transition point that we spoke about.
Okay, and that's when you kind of get out of Colorado then altogether. Is that going
Yeah.
back to Chicago from?
So
Yeah.
so that's a good segue into how and why I transitioned and decided to move back to Chicago. So while I was coming back to Chicago 1 week a month for 5 years straight,
So
I
that's a
was
lot of travel.
that's a lot of travel. I was single, but I ended up meeting my wife, my current wife, and so she moved back to Colorado with me. We ended up having a kid. We have a 7-year-old, but we decided at around 2016, 17 that we wanted to raise our son in Chicago. My in-laws are from Detroit. My family is here. And so when I knew that was going to happen, I knew that I had to do something with the business. Either I was going to run it remotely, I was going to sell it, what was I going to do next? All this planning started happening, and some of it, was intentional, where I listed my business for sale. Some of it sort of organically evolved as I started looking at larger opportunities, and then decided to liquidate my entire portfolio in Colorado. I still have one asset there, but almost everything except one. And then, of course, the main company, the construction development company, sold in 2019. But 2017, we moved back to Chicago, and really almost my entire focus was on building Ashland Capital.
Wow. Okay. That's cool, man. That's yeah, came back for the family, but sounds like you kind of wanted to go to that route and get out of the development side and go to the syndication side. Is that fair?
Yeah. I mean,
Yeah.
I certainly I did not want to run a construction company anymore. I did not want to have 40, 50, 60 employees at a time. I wanted something that was scalable, but with less people. That was a
Okay.
little more boutique and nimble. And that's ultimately, who we are today. We're a small team, but we're very nimble, but we can scale. We don't have to buy assets in our backyard, which, is what I did for 20 years. I didn't realize you can sort of own and operate and own assets around the country. I thought it always had to be in your backyard.
That's interesting too. Maybe you could touch on a little bit more, like obviously what Ashland Capital does, but also like just for folks who don't know, just from the syndication standpoint, maybe touch on what you do from that point of view from the syndication. You don't have to go into great detail, but maybe the one-on-one side of things of your day-to-day side.
Yeah. I mean, I think simply put, people have heard the term crowdfunding, right? So we just basically ourselves as general partners partner with a smaller group of limited partners. Those investors come in and out of deals depending on who has capital to deploy and invest with us. But we partner together to buy an apartment community. For the investors, it's passive. They're just passive investors. For us, we're the general active partners. We identify, we find them, we do due diligence, we buy them, we own them and operate them, and distribute cash flow profits to our investors. Said simply, right? There's a lot more details to it than that, obviously, but that's really in essence the structure. We're not a fund, so we buy each individual asset, as a separate single purpose entity. And you've got the general partners, and then you've got the limited partners, and we own it together. And that's what we do. And then, as opportunities present themselves, we'll buy another asset, build a portfolio. More investors come in with every opportunity, every deal, and that's how we've scaled and got to about, I think we're about $250 million under management right now and growing. And that's, for our business, that's a small boutique size firm. We'll continue to grow, but we never want to be a multi-billion, dollar firm. That's by design. That's the lifestyle I want.
Right, that sounds like you've been pretty successful so far, man. I got to say that's great. And you've been in Chicago doing this specifically since 2017. You said from Ashland Capital standpoint.
That's right.
Nice. And so you mentioned a few minutes ago then though, you realize kind of in being an LP, it sounds like out of Colorado, that you can do this across state borders. You don't have to do stuff in your backyard.
Yeah.
Are you guys all over the country right now, or any specific areas you focus on in particular?
Well, we focus on two larger geographic areas. That's the Midwest. We're not in Chicago.
Okay.
We're not in Illinois at all.
You're not in Illinois at all?
No, not at all.
Really?
As I said, the only reason that, well, I'm not sure I said it this explicitly. I live here for for my family, and
Yep.
this is where I'm from. But it's not a strategic, location for our business. I mean, we're centrally located. We can get to the markets that we like. So we're in Ohio, we're in Indiana, we're in Iowa, we're in Kentucky, and then further south, we're in the Carolinas, we're in Georgia, we're in Florida. So think about the Midwest and then the South, Southeast. Those are the two, larger geographic areas that we operate in. So, I think we're in about 11 to 12 states. But really the ability to scale, the ability to own and operate in multiple states really happened when I realized you can be a strong asset manager, but you don't have to vertically integrate and be the property manager. So
Okay.
for us, what we found, for now at least, is a sweet spot from being a very hands-on asset manager. In other words, my team that works for me, which came from some of them from the property management side, will manage the property manager. So on a
Gotcha.
daily basis, we are literally talking to the on-site property manager, maintenance staff. We're talking about rents. We're, every issue that comes up on a daily basis. So they really feel like they're an extension of our company, even though it's a third-party company. So primarily, we're using them for back office, administrative, accounting, et cetera. But the day-to-day, we're very involved, very hands-on. And that is what allowed us to scale and not feel like we have to, literally live in Des Moines, Iowa, and operate that asset.
Yeah, that's what I was going to ask. Because my next question was going to be, are you guys vertically integrated? But if you're all over the place, it's probably tough to do everything in all those markets. So,
Yeah, at some point we may be, but when you're spread out geographically, you don't always have enough scale in that particular market to justify being vertically integrated. So for now, we found a good hybrid of it, if you will. And at some point, as the portfolio grows, we may consider being vertically integrated fully.
No, that's a very interesting way you guys go about it. It sounds pretty cool. Obviously, it's working. You guys are really successful. As the fund manager there, like, how do you strategize on investments or new markets or stuff like that? Or if I guess that's a pretty broad question. We'll start there.
Yeah, well, there's really two main components of how we look at an opportunity. Number one, we're different than a lot of firms that basically wait for all these deals to come out that are brokered and marketed by firms that get blasted out to the world. We find those, for the obvious reasons, highly competitive and pricing gets bid up. So we avoid those at all costs. I don't think we've bought literally a single deal in a mass marketed, best and final brokered deal ever in throughout our portfolio. So we focus on off-market deals. So we're old school. I got a team of guys that hits the phones, and we work some, kind of a little bit more unique and nuanced ways of how we filter through data, who we approach and how we approach them. But it is generically put direct to seller, reaching out.
Okay.
Some of our
so you don't go through brokers per se.
We do, but it's got to be a compelling off-market opportunity with a broker involved. I'll give you an example. We just closed on a really nice deal, a student housing deal at the University of Arkansas in Fayetteville. The deal was brought to a broker. The broker said, "Look, I've got a couple of groups that I'd like to bring this to." This is what he's telling the seller. He ended up bringing it just to myself. The broker and I happen to be good friends, personal friends. He's a neighbor. And he said, "Look, the seller wants to do this quietly. If you can get to his number, I'm not going to shop the deal to anybody else. It's yours to lose." And that's exactly what happened. He put us in touch with the seller direct. We negotiated, we talked, put it under contract, and we bought the deal at a very good basis. And So those are the kind of opportunities that I really like. We're not looking to steal something. I mean, I think we're paying fair market where that opportunity is, but it's not getting bid up. It's not going
Mhm.
above market. And then we see a clear path to raise the NOI, to add value, um, and obviously execute our business plan. So there's multiple ways, that we'll find deals that are off market in essence, whether or not a broker's involved.
And because you're not a fund and dealing in kind of ways how they operate, you can be patient then with finding deals they take. You're not under the gun to spend capital and stuff like that.
That's exactly right. And that's why we're not a fund. I never want to be under the gun to deploy capital just to deploy capital. I'm
Got it.
I'm probably the largest investor of all of our investors. So of course I want to make sure that what we buy is the right asset in the right the right location, the right type of asset, and the right opportunity. So to answer your question more fully, so that off-market dynamic is a certain criteria for us. We've got to have a nice opportunity, not just a generic mass marketed deal.
Mhm.
And then the other metrics and things that we look at are fairly common throughout our industry. We're looking for um, good growth in a market. The market's growing, the population's growing, the employment is growing. There's diverse employment, um, and then something where there is an opportunity to add value. So our rents below market. Are they classic units that we can renovate and then force appreciation? So as long as there's a value add component, I mean, ultimately we're striving to solve for a return on investment for us and our investors. So if there's a path to doing that, you know, um, that's the criteria in essence that we look for.
Nice. Okay. No, that's really interesting. I got a lot of questions from that. What market do you think is hot right now, or where are you? If you could get an off market deal anywhere right now in the markets you work in, what would be the one you'd want to look for more
Uh,
or
there's
continue building?
there's a lot of them. So I love the Carolinas.
Okay.
Uh, we're under contract on a deal in Greensboro, North Carolina right now that I'm really excited about. We just sold a deal in Greenville, South Carolina,
Okay.
uh, and hit it out of the park. I think we returned almost 40% to our investors. So we have a deal down the road in Durham, North Carolina, another really growing market. So the Carolinas are hot. We love them. But I also like so those are high growth, really
Hmm.
hot markets, right? So it's good and bad. A lot of the marketed deals get bid up, but the
Right.
off
Right.
marketed deals, if we can buy them at the right price, they're still going to have the tailwinds of the market, and we'll be able to force appreciation. So we like that. But I also like more of what I call kind of like the steady Eddie markets, like the Midwest. They're not high growth, but they're very predictable. It's just a solid, even growth. And we like that as well, for good, predictable cash flow. So we have an asset in Des Moines, Iowa, for example, that's doing extremely well for us. We really like that market. Um, Florida is a great market. Arkansas, especially Northwest Arkansas.
Hmm.
I mentioned the deal that we bought in Fayetteville on the student side, but on the conventional side, if you look at that area around Bentonville, where Walmart is
Hmm.
headquartered,
Absolutely.
that whole little pocket is blowing up on the conventional side. So, um, but as I will say, and I've said and will continue to say, that there's a lot of markets where you can make money. You just have to buy right. You have to know where you are in the market, the type of asset, how you're positioned against other assets. You can make money in real estate in many markets.
Yeah, that's good to hear. I have a friend that actually just moved to that area in Arkansas, and he was living in Southern California with myself, and obviously we were speaking. I just moved out of there too, and I was curious as to why, but it seems like there's a lot of really cool stuff going on in that part of Arkansas, which I was not familiar with.
Yeah, when I
So
when I first got to Fayetteville, when I was first looking there, it felt a little bit like Colorado. Fayetteville's a college town, and there's rolling hills, there's big mature trees, there's a big mountain bike community out there.
he
Uh,
told me all about that. The
yeah,
the Waltons invested so much money to it's like the best mountain biking in the world, apparently.
Yeah. Yeah. So it's very cool. It definitely has a cool vibe. You wouldn't think that you can compare Northwest Arkansas to Colorado. At least I never
Hmm.
thought you would, but there's definitely a parallel there.
Nice, nice. No, that's really cool. Well, so talk to us about the current economy today, right? Do you obviously from if you had a crystal ball, what would you think is going to happen? But like maybe touching on the debt markets, do you guys use debt a lot on purchasing properties, and do you see like anything going on with lending practices and affecting deal flow in your world right now?
Yeah, it's certainly a challenging time. The debt markets have really disrupted the market. There is rising interest rates and there is less leverage. So, a deal that you could, lever up to 80% loan to cost, just a year ago, you're going to be at 65% loan to cost.
Okay.
And of course, a higher cost of capital. So that's created an interesting dynamic. I think the biggest issue right now you have is less transaction volume because you have sellers that have last year's pricing in mind, and you have buyers like us that will only buy for today's pricing, which is I have to
Hmm.
adjust for the cost of capital, I have to adjust for the leverage, and in my view, which is not, I'm not alone on this. Many people believe we're going to have some softer economic times. So I want to make sure we're not underwriting for really aggressive rent growth and things that are just, they might happen, but they're aggressive and we don't know if they'll happen. I only want to underwrite to what have high conviction on. So all that being told, it leaves a gap between buyers and sellers.
Hmm.
Um, but I also think it's an opportunity. So I think there's, you know, as always, there's opportunity when there's disruption. So there's less competition because there's just less deals happening, and some buyers have gone on the sidelines, which is great because I'd rather have less competition on the buying side. I also think there will be some distressed sellers in the next year, and we're talking to our investors to be ready to have capital on the sidelines, keep dry powder, and be ready to jump on opportunities where we have potentially, you know, a shorter time frame to close because someone is in distress, and we need to be able to react quickly and take advantage of the opportunity. So, for us, it goes back to being patient. We'll wait for the right deal. There'll be good deals. But I really believe as long as you're underwriting and buying for today's pricing, not yesterday's pricing, that you will make money in every market. So we still have high conviction. We have a housing shortage. Apartments are always going to be in demand, especially in the asset classes that we mostly buy in, which is C and B value added. It's affordable housing. It's blue collar, gray collar type of demographic. And in today's interest environment, they can't afford to go out and buy a house because 6 months ago they could afford to buy a $300,000 house. Today, that same mortgage payment will get you a $200,000 house. So that all helps us actually because they're going to continue being renters. So
Yeah,
there's
no, that's a
definitely
good point.
more demand.
Yeah, that's an interesting way to look at things, but obviously that's how you have to, from the demand side of things for sure. Are you? I mean, are you seeing a deal slowdown right now of deals coming across your desk?
They, yeah, we're seeing a little bit less deal flow. We're also, we're seeing deals not get done. So we're seeing a lot of deals
Okay.
that this is a crazy dynamic, but just give you like round numbers where we see a deal come out, the whisper price, the broker says, I think the seller will transact at 60 million. We underwrite it. We're getting nowhere close to 60 million. We're getting, to 50 million, for example. Give the broker feedback, and the broker says, sorry, you're not even close. Appreciate the time you've spent. Fast forward, a month, and that's where the market is, and they're not getting offers at 60. And all of a sudden, they come back to us and say, if you can have strong terms, we might entertain 50. So you're seeing a lot of that, or
Okay.
you're seeing that the sellers are just saying, if I can't get 60, I'm not a seller. They don't have to sell. So that's where you're seeing a reduction in deal flow. The guys who don't have to sell, it's really not a good time to sell because they have to adjust their pricing. If I, and I am, an owner, and I don't have to sell, I'm going to wait until it's the right time to sell. And that's the beauty of real estate, that it's a timing game as well. You never want to be forced to sell. You want to be able to have flexible debt and hold on to that asset until it's the right time to sell.
Those are some strong words right there to live by. I feel like, because I like that a lot. All right, so we've got some rapid fire questions. Let's see if I can do this properly. We'll see if we can answer these quickly here. If you were given 10 million today and you had to invest it immediately, what would your go-to asset type be? I think I know the answer to that. And what about the location?
All right, I would take the 10 million, I would, spread it out in probably a couple of buckets, and I'd buy some student housing, I'd buy some conventional multifamily. It has to have a value add component. It would likely be in the Carolinas and maybe one in the Midwest.
Okay. Student housing or multifamily? What's easier? Or less management intensive, maybe, is a better way to put that.
They're about the same for us because we don't self-manage them.
Right.
It's just a different sort of flavor, if you will, different business plan. So we like student housing a lot because it's also a higher barrier to entry. Not every conventional multifamily guy is going to enter that space because it is a different type of operation and requires expertise. So, and long story to that, I'm not sure we have enough time on this episode, but we have some really strong expertise on our team in student housing, and our student housing portfolio is just killing it. So, that wasn't really rapid fire, but I tried.
Favorite tool or software that you like to use on the job?
I've got the guys on my team that are millennials that are much better than I am at software and tools. I will tell you, for me personally, what I use the most is LinkedIn, because I love to see
Okay.
the deal flow. I love to see what people are talking about. Meeting other folks in my space, just to network. To me, that's just a great tool outside of sort of the under the hood nuts and bolts of what we do on an everyday basis.
Love it. No, LinkedIn's the best. Most common misconception about what syndication or investing in multifamily student housing is?
I think the biggest misconception is people think that they have to be uber wealthy and have to be some sort of institutional player to invest. Most common day folks, your doctor, your middle level manager, whatever they are, don't realize that you can just find a good private equity firm, call them up, see what kind of deal flow they have, and invest. Some firms will let you invest as little as $50,000. So I don't think people realize the ease of investing, and then that you could truly be passive and hands off.
Didn't realize that either, for the most part. That's great to hear. Favorite or most creative development project, either that you've seen or worked on in all your years in real estate?
I would say what stands out the most is a house I designed in Durango, Colorado, that everybody who looked at this lot said that it cannot be built. It is a horrible lot. And I'm proud to say that a client called me and said, I want you to look at this. Is this developable? What can we do here? And he bought it and we developed. It was a very steep lot. Anyways, long story short, I've done this a couple of times, but we designed a very unique house that hangs over a cliff. It's absolutely stunning. It was highly technical, highly stressful, but we pulled it off and won awards and had an extremely happy client and so much fun. That's on the single family side, but we've had some fun with larger developments. But those unicorns, those really unique ones that have a really artistic flair, and the ones that people say can't be done, always stand out as some of your favorite because we did it.
That's cool. No, I bet I've seen some cool stuff in Colorado out there, so I'm sure there's yeah, I'd like to see some of your projects, man. Some of the past ones. I bet they're really cool. So I I guess the question I have for you, how come this is kind of just a personal thing I'd like to know, like why you guys don't do anything in Illinois? Is it taxes or politics or a mix of both?
Add the crime in there, and then you'll have them all. Yeah, and that's an unfair statement for Chicago. But that has been primarily it, that, all these things that are happening are challenges. I love Chicago, and it's
Hmm.
an amazing city. And even with all those dynamics, there's plenty of pockets of Chicago that are great and are blowing up. You go to Fulton Market, West
Hmm.
Loop, and it's just on fire. So would I do something? Absolutely. Um, but we found enough opportunities outside of Chicago, that we haven't had to. But it will not be long before at some point we pull the trigger. We do something here locally.
Nice, nice. So you just in talking about like the markets today and stuff, and where you guys from your firm are buy, sell, hold, or hold, it sounds like, and buy. Anything in particular you'd recommend?
Yeah, I mean, for us, we're holding. We've got great assets. We're taking them through our business plan and through our cycle. The only reason we sold one this year is somebody came along and offered us what we modeled for to sell in 5 years after two
Oh
years.
wow.
So they paid us a
Okay.
great price. We had a massive return to our investors, and we sold. Sometimes you take a few chips off the table, but in general, we're net buyers than sellers.
Uh, okay. Cool, man. Cool. What advice would you give to newcomers, or those looking to get into syndication or multifamily investment, maybe outside of, let's say not the person that wants to do the just be passive on it, but if you're trying to get from the active standpoint?
Well, just like myself, that 10, 12 years ago, whatever it was when I started out, I would start as an LP, a limited passive investor. So you can see the process, you can see how the underwriting works. You really can learn and see under the hood, so to speak, from a passive investment standpoint. So that's where I would start, and couple that with reading podcasts like this, like you guys, and I'm sure you guys have great guests. Listen to as much as you can, be a sponge, and at some point you just have to jump in, and I'd say, jump in on the smaller side of things, learn, and then just keep scaling up. You know, it's a lot of guys just sort of deer headlights syndrome, and they'll end up, listening to podcasts, reading books for 5 years, and they'll never do anything.
Anything?
So,
Yeah.
do something, but do something that you can afford to lose, so to speak. You know, um, don't bet the farm without
About the
having more
farm. Yeah.
experience.
Oh, that's a good piece of advice there. Back to like just the multifamily student housing thing. That's something that I'm kind of interested in. Like, is there one did you start multifamily because that was kind of more like a single family transition into the commercial game, or was it both at the
Well,
same time?
I guess in fairness, when I first started buying rentals in Colorado, there's a small school, Fort Lewis College. Um, it wasn't even called student housing; it was called college
Okay.
rentals. You know, I mean, the student housing space hasn't been institutionalized for more than about 15 years. It's really a new institutional vertical. It used to be just mom and pop owners, and it was called college rentals, and that's the way I started. I started assembling, these houses that I knew that college kids would want to rent, and I just kept buying more and more and more, and that's what I did. So I started out, really both buying conventional because, I wasn't sure it was going to rent it. Were they going to be college kids or some guy that has whatever, a construction job? Um, so I like both. And I would say buying institutional size student housing deals has been the last 3 years for us. And we love it. It's a great asset class.
You guys, is there a lot of competition in that space? right now, or is it still more undiscoverable, if that makes sense, compared
It,
to
it's
multifamily?
it's discovered. I would say
Is this
the only barrier to entry is operationally and capital wise, but it is certainly an institutional asset class. In fact, BlackRock or Blackstone just bought a $13 billion student housing portfolio. I mean, so there's
wow?
been more money pouring in, institutional money pouring into student housing. It's shattering records. And one of the interesting reasons is student housing actually caught the attention of institutional capital in 2008 and 9 because counterintuitive to a recession, student housing had its record years because kids went back to school and they stayed in school longer. It makes sense if
Makes sense.
if there's not a lot of jobs, you're like, hey, I'm going to stay in school. I'm going to retool and get some new skills. So after the Great Recession, it really caught the attention of institutional capital, and with the obvious softer economic times that we're going to have for the next year, 2 years, you're seeing people just recognize student housing as an opportunity and pour a ton of money into it.
That's and I didn't think about it like that, but that makes a lot of sense. And you've seen it through a couple cycles, it sounds like. So probably going to continue getting bigger.
Yeah, absolutely.
You mentioned just like Blackstone or BlackRock getting into that game. Obviously, they're deep into the single family rental portfolio game. Do you do anything in that too, or are you primarily multifamily or student housing for traditional, if that makes sense, versus single
Um,
families?
so for Ashland Capital's portfolio is strictly multifamily, 100 units
Okay.
plus, in student housing, 100-bed plus. I
Okay.
personally have some single family rentals that I still own. So I believe in the space. I think it's a great asset class as well. We've looked at some opportunities to buy some build to rent communities, possibly develop some build to rent single family or townhome communities. So again, I think at the right opportunity, we'll play in that space, but it's highly competitive.
Definitely. At least I read a lot about it, so I got to assume it's very competitive in the institutional side of things.
Yeah.
Nice, man. Well, we've been going for a while here. I really appreciate the time. Any parting words that you'd want to share with our audience? I know we've covered a lot of stuff here, but it's September 20th today, 2022. We're going into some, who knows kind of where it's going. But if you had your crystal ball, anything you want to share with the audience of what's going on?
Um, I'm not sure other than to say, look, real estate has been good to me for almost 25 years now. I believe in it. So I'd say everybody should have some allocation to real estate in their portfolio. And we're seeing more and more high net worth, ultra high net worth institutional capital putting more and more capital in real estate. So I'm not as smart as those guys, but it's worked for me and it's obviously working for them. So it's obvious. I think it's a great place to be, a great place to invest. So I'd say be patient, look for the right deal and then invest and then just wait and collect that mailbox money.
That sounds like a good plan to me, man. I'm gonna take some of this knowledge you've imparted on me and put it to work. I promise you that. So I know you're based here locally in Chicago. Where can we find you online? Email, social media. I know you said LinkedIn, so maybe it's LinkedIn. But if anyone wants to get in contact with you, either to invest in something you've got, from the private equity side, or just to connect on LinkedIn or something like that.
Sure. So our website is ashlandcapitalfund.com. So you can get on our website and find me through there, or you can email me direct. I'm the guy who can't spell his name, so it's Alix with ALIX, Alix at ashlandcapitalfund.com. And of course, we're on LinkedIn, Facebook, so it should be easy to find us.
Nice. Well, this has been a lot of fun, Alix. We obviously appreciate your time greatly. I know you're busy with everything you've got going on with Ashland Capital. So thanks so much for joining us today, man. This has been great.
Yeah, it's been fun.
Yeah, no, absolutely. Hopefully, we should do this again sometime, either about student housing or about multifamily or about going to teach at the Navajo Nation. A long time ago. It sounds like we could take the next one a couple different ways, depending on what the marketing team here thinks will attract some ears.
Absolutely. Love to. I appreciate the time, Matt.
Awesome. Awesome. Well, thanks to everyone who tuned in today. If you enjoyed this episode, do not miss the next one. Visit go.crexi.com/podcast and sign up to get the next episode delivered straight to your inbox. Of course, you can always subscribe to the Crexi Podcast on your favorite podcast app and check out our YouTube channel for video recordings of each episode. Take care and be sure to tune in next time.